All right, thank you so much, ladies and gentlemen, and welcome to this particular episode. All right, fantastic. Now, today I want us to discuss 10 common mistakes that you as an investor, you're not supposed to be making. 10 common mistakes that investors normally make and you're not supposed to be making. And remember, guys, these common mistakes that I'm going to discuss with you here are very important because you're supposed to learn from them and do away with them or shun from them, because if you continue doing them in your investment, then you are going to realize that it's going to cost you a lot even when it comes to your investments, and you're going to make losses. So ladies and gentlemen, I suggest that you watch this video up to the end if you are an investor, because this video is going to have a lot of informative content and it's going to help you a lot. And ladies and gentlemen, because I'm going to discuss 10 points, I'm going to have my notes here, so I'll be referring from my notes so that I can remember everything that I've written. So if you see me looking on this side and then turning my head to the other side, I'm just referring to my notes so that I make sure that I don't forget anything. So I don't want to waste any time, ladies and gentlemen. I'm just going to direct to my video and to my points so that we may not waste any time. All right, now, ladies and gentlemen, 10 common mistakes that you as an investor, you are supposed to avoid making. Very nice. Now, the first common mistake that you are supposed to avoid making as an investor is lack of research and due diligence. Now, the first one is lack of research, and due diligence, right? Lack of research and due diligence. Now, ladies and gentlemen, I'll be giving you a point and then I put it on the whiteboard so that if you want to take the notes, you can also take the notes. And then immediately after I've given you the point, I'll be discussing it just with a small explanation so that you can understand what we are saying here. Now, lack of research and due diligence. This is whereby individuals are going to do investments without, first of all, understanding what they are getting themselves into. And just to give you a practical example, for example, if you want to invest in money market funds, or if you want to invest in shares, or if you want to invest in government treasury bonds, or if you want to buy corporate bonds that are going to be offered by corporate organizations, or if you want to buy treasury bills, you get into that particular investment without understanding first what exactly is that particular investment. And that one is going to cost you a lot, because if you find out later that it did not align to the purpose of your investment, then you find out that, oh, I put money here, but it has not helped me. And that one is the kind of disappointment that you are supposed to avoid. So, ladies and gentlemen, lack of research and due diligence. So when you lack to do research about that particular investment, you might find yourself putting your money in an investment that initially you thought it was the one that you thought that you wanted, but later you come to realize it's not the kind of investment that you are looking for. For example, if you wanted to invest in a money market fund and then you decide that you are going to invest in shares of a company, you're going to buy shares, and then later in life you come to realize that, oh, shares are not liquid. Oh, kumbe, if I buy shares, it takes me time to sell them so that I can have the money back. Oh, kumbe, if I buy shares of a company, sometimes they can lose value. And actually, if I had bought shares of worth 100,000, if the price goes down or the value of the company goes down, I might actually lose my money. So those are the kind of the questions that you're supposed to ask yourself even before you put your money in any kind of an investment. And that's where we are talking about lack of research and due diligence. Due diligence is like doing what you're supposed to do before you do what you want to do. Hope you get my English. Doing what you're supposed to do before you do that investment or before you do anything. The due diligence, all right? So lack of research and due diligence, it's something that you're supposed to check so that you might not mess up with your investment. That was the first point, ladies and gentlemen. So make sure before you get to any investment, just take your time. Sit down, relax, Take your time, go through the facts about that particular investment, understand what kind of a contract is that you want to get to with your fund manager or so the person that you want to invest your money to. So ladies and gentlemen, very important, you need to take care of that. Now, ladies and gentlemen, just to give you a disclaimer on that, so what you're supposed to do is, first, you are supposed to spend time, think about the kind of an investment that you want to do, and then research on it and see that actually this is the kind of an investment that I want to do, all right, before you do any kind of an investment. Now, second one, ladies and gentlemen, without wasting time, letting emotions drive your decisions. Letting emotions drive decisions. Number one. Number two is letting emotions drive decisions. Letting emotions drive decisions. We are human beings. I understand. We are human beings. But in most cases, when it comes to financial decisions and investment decisions, do not let your emotions drive these kinds of decisions. And this is where you're going to find guys making impulsive decisions based on the market fluctuations and the stress they have. For example, right now we have a lot of individuals with stress when it comes to just life stress. Probably you're not having money to pay school fees and so on and so on. So you're mixed up with a lot of emotions, family stress, like the market is not taking you well, the business is not doing good, you went on a loss on that particular year 2024, you registered a loss of a certain amount. And then you are mixed up with a lot of stress and emotions in your head. Now, at that particular moment, ladies and gentlemen, you are not supposed to make any financial decision, because most probably, in most cases, you are going to make a decision that is biased. You are going to make a financial decision that is not going to serve your purpose. At that particular moment, because of the emotional nature of the one that is influencing you inside, you think that you are making a very good financial decision, but later you realize the kind of decision that you are making was not good. It did not serve the purpose that was intended initially. And that's why you come to regret that, oh, I wish I could have just remained calm, relax, clear my head, and then come back and try to make that financial decision. So, ladies and gentlemen, letting emotions drive decisions. For example, when there is even market fluctuations and then you feel like, these things are just taking me like this and like this, what am I supposed to do? For example, when it comes to market fluctuations, like for example, now, like the case of money market funds, you see the money market funds rates have gone down, and then you go there with a lot of emotions. You feel bad that the rates have gone down. You withdraw all your money, and then you decide to take them to buy shares. And then when you buy those shares, then the company goes down, and then the value of shares, even the money that you had invested there, all of it, you lose all of it. So, ladies and gentlemen, market fluctuations, stress, and other kind of reactions or emotions that you might find yourself mixed up with should not influence the decision making process when it comes to investment. So, what is my expert opinion here? You are supposed to remain cool, give it time. Always take time when it comes to investing decisions. If it's anything to do with business, market fluctuations, political instability, economic whatever, those things, just give them time. Even money market funds right now, you are experiencing down, the interest rates going down. You don't know whether they are going to go up in future. So you are just supposed to remain calm and see that you have made the right decision. Ladies and gentlemen, let's go to number 3. Our point number 3. So I hope you're following this well. Then we have insufficient diversification. I think I have talked about this in a lot of videos that I've created in this particular channel. Insufficient diversification. Now, insufficient diversification, ladies and gentlemen, is whereby you are going to, let me just adjust my mic here. Insufficient diversification is whereby you are going to, you have not diversified your money the way it's supposed to be diversified. So you've, like, let me just give you a scenario. If it's like, for example, you had 5 million, you have put it in probably money market fund only and shares. So you have not diversified, because when it comes to investments, you're supposed to make sure that you have diversified your money in several investments or in several sectors. We talked about geographical, we talked about asset-based diversification, we talked about sector diversification, and we talked about geographical diversification. And we said sector diversification is where you're going to invest in different sectors. For example, education sector, finance sector, legal sector, and so on, agricultural sector, and so on and so on. Now, geographical diversification is where you're going to invest your money in different geographical locations. For example, you can say that I might invest in Kenya. At the same time, I might buy some shares outside the country, just to make sure that you might even convert your money in terms of dollars, you know. So that is what we call geographical diversification. What are you trying to solve here? The risks is what you're trying to avoid. We also have the asset class diversification, whereby you can diversify in your money. You can say, let me put 1 million in money market fund. The other one, you can say, let me buy some shares here. The other, you can say that, let me buy some treasury bonds with the Central Bank of Kenya, and so on and so on. So those three types of diversifications are very important when it comes to investments here. So insufficient diversification, ladies and gentlemen, is something that is going to cost you, because if you put your money in one area or two areas, or probably insufficient ones, then if there is some crisis, those areas and they suffer. If there is some crisis and those areas suffer, then it means that you lose your money, or your investment portfolio, almost 80% of it is going to be affected. But if you had done some good diversification, or probably you had put your money in 6 different areas and it's only 2 areas that have been affected, it means your investment portfolio is still intact, and therefore these 4 remaining investment portfolio can be able to cover up for the ones that are affected. So ladies and gentlemen, insufficient diversification is another common mistake that you're supposed to avoid when it comes to investments. All right, so ladies and gentlemen, I hope that you've got that. Now let's go to our 4th common mistake that you as an investor, you are supposed to avoid, and we are talking about chasing hot deals. Oh my Jesus, this one is very common. Chasing hot deals. Let me just laugh, because this one has affected a lot of people, and I've seen a lot of people lose a lot of money because of this. This one I call greed of money. You know, greed of money. Like, you don't even take your time to evaluate whether that particular investment it's viable in long term. You know, if it's viable in long term. What do I mean viable in long term? Like, it's something that is going to last longer. Now, you've heard of these investment schemes that normally come up, and then probably they are going to do well in the first 3 months. Then in the second month, you hear people that, oh, we were conned, sijui nini, the website is not working, oh, they are not paying, they are not returning the text, oh, sijui nini. Those investment schemes are what I'm calling chasing hot deals. And it does not necessarily have to be those kind of investments. Even when there is for example, if you're doing live trading of shares, and there is this kind of a lot of people are buying shares, and there is that kind of market rise in terms of shares, and then you are going to chase that hot deal, and you're going to tell yourself that, now I want to, do this so that I can be able to beat the market. You can be able to beat the market in quotes, and then you find yourself in crisis, but you don't know that you are suffering, only to realize that at the end of it all, you find yourself in a very big mess. So this one is going to happen in peer pressure, because people, you want to you want to be like the other person who is doing a similar thing, and you see that they have gained some money, but you just want to be like them, so you do the same thing that they are doing, then boom, you just lose your money like that. So ladies and gentlemen, chasing hot deals, first, relax. Second, identify or verify the viability of that particular investment in terms of long term. Is it something that is going to serve you for a longer period? Understand the dynamics of that particular investment and see, actually, this is something that is going to help you. Just know whether it's fake or not fake, or it's something that is going to go for 2 months and you have invested your millions there, and then everything is lost. So ladies and gentlemen, be very careful about this particular point, chasing hot deals. All right, chasing hot deals. Now let's go to our fifth point, and we are talking about overtrading. We are talking about overtrading. You know, we say too much of something is poisonous. Too much of something is poisonous. When you eat a lot, you're going to experience some problems in your stomach. All right. When you eat a lot, you're going to experience some problems in your stomach. Too much of something is poisonous. And according to this point, ladies and gentlemen, we are saying that frequently buying and selling in attempt to beat the market. You know, listen here, to beat the market in quotes. You know, there are those guys that are going to, that you have convinced yourself that for you to actually be in a better position when it comes to trading and selling, you're frequently going to engage yourself in the exercise of buying and selling, buying and selling, buying and selling, so that you can beat the market. And you feel that if you do that frequently, that is the time that you are doing well when it comes to trading. Or, you know, here when we talk about trading, we can either refer to bitcoins, how people do forex trading, and also we can also talk about the shares, the live trading of the Nairobi Securities Exchange, and so on and so on. So that frequent trading that you might not know that is costing you, for example, if you do a lot of transactions, you are paying for transaction fees. Then if you gain, if you have profits, then there is that aspect of taxation, and you find yourself now, what are you supposed to do? Because this one over trading is going to cost you a lot. First, you need to focus on long term. You need to come up with a long-term strategy of investing, or a long-term strategy of trading, because I think the long-term strategy of trading, it's going to work because you are going to focus on future rather than focusing on the short-term goals of investing, because the short-term goals of investing might not even satisfy your needs or fulfill the purpose of you trading. Because if you do over trading, in most cases you are going to make losses. But if you focus on a long-term strategy or long-term goal of investing or trading, then you might even find yourself in a very good position actually to be able to do that. So ladies and gentlemen, you need to focus on long-term strategy. High frequency strategy can incur significant transactions, and of course, you are going to pay a lot of taxes even when you gain some profit. So focus on long-term strategy or long-term goals, all right? So that is our point number 5, sorry. That is our point number 5. We go to our point number 6. Ladies and gentlemen, we go to our point number 6. Neglecting fees and taxes. That is the sixth thing that, you know, you are not, there are some costs that you need to capitalize them. When you are doing investments, or even when you are doing your business, there are always costs that you need to capitalize them as expenses. So this is a common mistake, neglecting fees and costs, or neglecting fees and taxes, not costs, taxes. So ladies and gentlemen, when you are an investor, it should be in your mind that you are going to have some fees, for example, transaction fees. And then it should be in your mind that you are going to have some taxes, because profits are taxable even when it comes to investments. Now, there are people who are not going to recognize this small because they feel that they are so small and they don't make any impact when it comes to investments. For example, if you decide to put 5,000 or 10,000 in a money market fund account, there are some money market funds that are going to charge you they are going to charge you a transaction fee of around 50 shillings. Now, you might think that the 50 shillings, it's not making us any significant difference or it's not impacting anything here. But now, ask yourself, if you put 10,000 in a money market fund account and it's supposed to compound daily, ask yourself first, how much is 10,000 giving you daily? And because you have incurred a transaction cost of 50 shillings, how long is it going to take you to recover the 50 shillings? You get what I'm saying? How long is it going to take you to recover the 50 shillings that you have incurred here as a transaction? Because if you look at it well, if you just do a very quick practical example there, 10,000 can probably earn you around less than 5 shillings. So it's going to take you a couple of days to make it to 50 shillings, all right? So those are the kind of fees and taxes that you are supposed to recognize and capitalize them as expenses. And ladies and gentlemen, even when you get your profits, you're supposed to get your net profits and then less the taxes and see what you are being left with. Do not just take the whole amount as the summation of everything without taking into consideration the fees and taxes. Even if they are so small, if you accumulate several of them, then they become a very big amount. So ladies and gentlemen, neglecting fees and taxes is another common mistake that you're supposed to avoid as an investor. Let's go to number 7, ladies and gentlemen. Let's go to number 7. Very interesting. Now, number 7 in my list, we are talking about trying to time the market. You know, this one is very important. Trying to time the market. I'm not going to give you a very complicated scenario here by what we mean by trying to time the market. For example, let's just use an example of money market fund. Now, there is someone in January 2025, they wanted to invest in money market fund account. But now they realized that the interest rates of money market funds were actually going down. So they said, oh, they are going down. Now, let me wait and see the time that the interest rates are going to go up so that I can be able to invest at that particular moment. Now, that is a person who is trying to time the market to see whether the interests are going up or they are going down. And then there is this guy who is going to wait for the interest rates to go down so that they can withdraw their money from that particular investment and probably try to find somewhere else so that they can be able to invest. So ladies and gentlemen, this is a common mistake that if you have decided to invest, if you have decided to invest, do not try to time the market. If there is an opportunity for you to put that money and actually get some returns, even if the money markets are going down, but there is that return that you can still get and maintain the capital that you have, then you do that. Because we say that you are supposed to focus on long term. Your goals are supposed to be long term when it comes to investment. Because if you align yourself in short term goals, then it might not make a lot of sense in you and you might probably miss the opportunity there between, and you are going to find that you put your money in an investment that is not fulfilling your needs. So ladies and gentlemen, trying to time the market, if it's a money market fund, put that money right now. Even if they are going down or they have maintained a certain level, put that money inside. Get what you are getting, move on. If it's shares of a company, do not wait until you hear Safaricom now is a very big company, you know, now we can put money, they are offering dividends at this particular rate, or the Nairobi Securities Exchange has done this and that. Now, that is the time you are thinking, oh, hey, actually doing well, now let me put money there. Now, that one is a very worst decision making in terms of financials, and you think that you are doing yourself great or think that you are an expert in finance, but even investors, that is not how they do it. So ladies and gentlemen, trying to time the market, it's not gonna work. because if you time, you might time, sometimes you might time and probably make some money, but you might time when you think that a company is, for example, let me just give you a very good scenario. If a company goes up and the value of shares goes up, someone is going to get in, because the people who are already in, are going to make a lot of profits. And when they make a lot of profits, what do? They sell the shares because they need the profit. When they sell the shares, because will be a high supply of selling of shares, there will be a high supply of selling of shares. And when the supply is high, it means the demand is low because everybody is selling. So the person to buy, it's not there. Now, when the demand is low, what happens? The prices of the shares goes down. Now, when the prices of the shares goes down, and you thought that because company XYZ is doing well, you invested, you decide now to buy shares at that particular moment, that the share price went up or the value went up. Now, after the supply of shares has gone up, because a lot of people are selling so that they can have the money, that's the time you realize, oh, now the price is going down, and that's how you lose your money. So ladies and gentlemen, do not try to time the market, just be there. Invest. If you want to invest, put your money there, wait, and be a long-term investor and focus on long-term goals. So have a strategy, an investing strategy that is going to help you navigate through the market. So ladies and gentlemen, that is our point number 7. Now our point number 8 is lack of clear plans and goals. You know, there's just individuals lack of clear plans and goals. Now, when I talk about lack of clear plans and goals, ladies and gentlemen, they are just individuals who are just going to invest for the purpose of investing. Hey, Jemo, umeweka pesa kwa money market. Hey, hata mimi. Hey, unatumia gani? Hey, tika. Okay. Hey, hata mimi wacha. Unaregister aje? You know, you get yourself into an investment simply because your friend is there. You're just doing it out of peer pressure. But it's not a specific goal inside you, or you've not told yourself, now at the end of this particular year, I want to have saved 200,000. So what should I do? I should put money in a money market fund account so that by January 2026, I withdraw the money so that I can be able to start that particular business. So your goal, you don't have a goal. You saw someone investing, and because they are getting some interest, now you get there so that you can get some interest. But in real sense, there is no goal at all. So then you don't have clear plans. You don't have clear. You need to be clear with your goals. For example, you say, I want to put 10,000 in a money market fund account for 1 year. Then after 1 year, I need to open a business worth 100,000 or 120,000. That is now having clear goals. So when you do an investment without having clear goals, ladies and gentlemen, that one is going to be a very bad financial decision, because sometimes there are people who say, oh, you are trading in Nairobi Securities Exchange. How someone do it? You feel like you are being left behind by your friends because they are in Nairobi Securities Exchange and actually they have bought shares. No, you have bought shares of Safaricom and you're my friend. Now you feel like you are left behind, but this person who is already there has some purpose and goals. But you don't want to feel like you're being left behind, even without a purpose and the goal of buy shares of probably Safaricom in whichever company or KCB. You just want to get in so that you can be the same level with your friend. You know, that peer pressure should stop when it comes to financial decision making. So ladies and gentlemen, our point number 8, lack of clear plans and goals. You should avoid that. So what am I saying here? You should always make sure that you have defined your goal, defined your short-term and long-term goals before investing, so that you can know the purpose of that particular investment, so that later in life you might not come to find out that, oh, I opted this particular investment, but now I don't see it fulfilling the purpose or intended purpose at the beginning. So ladies and gentlemen, be very careful about that. Now, our point number 9, ladies and gentlemen, let's talk about overlooking the importance of risk management. You know, overlooking the importance of risk management. Now, Ladies and gentlemen, when you hear the word investment, you know definitely there is what we call returns. When there is investment, there is a return. When you put your money in a money market fund account, you expect something in return. You expect some interests. Now, when there is a return, there is risk. All right. So we normally say money market funds are less risky. Now, there are some investments that are going to have high risk, but they have high returns. Those investments that are going to have low risk, they have low returns, ladies and gentlemen. So investments, returns, and risk goes hand in hand. And that's why you are not supposed to overlook the importance of risk management. So therefore, what am I saying concerning this particular point? That anytime that you are analyzing an investment or you are coming up with an investment strategy or a strategy, a long-term or a short-term strategy of investing, you are supposed in that particular strategy or plan, you state your risk management plan there. For example, if it's money market fund, you want to invest in a money market fund, how are you going to manage the risk in that particular money market fund? If you want an investment portfolio, how are you going to manage the risk in that particular investment portfolio? For example, one of the risk mitigating factors is, and we talked about it, is where is it? Where is this? Yeah, here. Diversification. And we have talked about diversification as one of the risk mitigating factors, whereby you're not going to put all your eggs in one basket. You distribute your income to several investments just to make sure that if one fails, the other one is not affected. So ladies and gentlemen, do not dare or make that common mistake of overlooking the importance of risk management. For example, if you want to trade shares of a company, or if you want to buy shares of KCB, Safaricom, or whichever company, ask yourself, look at the financial stability of that particular company. Look at the financial history of that particular company. Look at the dividends and the way they have been paid from the year 2019, 2020, 2021, 22, 23, and 24. See if there is some rise or going down, or look at the trends of the financial statements of that particular company. What are people saying? Look at it so that you can know, you can have a clear picture and see, actually, I can be able to put my money in this particular company, or I don't think I can invest here because of this and this and this. So you need to, and research and reading a lot of articles is one of the ways that you can be able to plan for the risk and actually mitigate risk. So ladies and gentlemen, our point number 9 is very important again. Overlooking the importance of risk management is another common mistake that you need to shun away or avoid. Now, on to our last point, ladies and gentlemen. I hope that you are enjoying this. We are almost through. It's ignoring continuous learning. Now, this one is our last point, because I normally say, let me just first of all put it on the whiteboard, ignoring continuous learning. Now, you think that now you know how to invest or to trade, that you think that that is all. What I can tell you is that investing is a learning process. And when you start investing, don't think that you know everything. Markets are going to change, investments are going to go away, and new investments are going to come up. So do not think that you know now how money market funds operate, how you can buy shares and trade there, how you can trade in Nairobi Securities Exchange. Now, because you know how treasury bonds and treasury bills work, you think that the markets and the dynamics of the markets keeps on changing. So you need to keep on updating yourself on this kind of information. And how are you supposed to update yourself? For example, number 1, read books. You need to read articles to do with finances and so on and so on. Make sure that you visit websites online and look at those particular areas and see how the trends are going, so that you can always be updated. And it's one way again of risk management, so that if you hear that money market funds rates are going down, you are not surprised, because you know what is happening. It's not like, oh, ati nimesikia, hey, we need to remove our money, you know, such kind of things. So ladies and gentlemen, ignoring continuous learning is another. You become an investor and then you are just a silent investor. You put your money, you don't know whether people have eaten your money. You buy shares, you don't even know whether the company still exists. You are waiting for dividends at the end of the year. It's going to be very funny. So ladies and gentlemen, do not ignore continuous learning. You need to keep track of your records so that you can always be updated. So ladies and gentlemen, those are the 10 common mistakes you as an investor, you're supposed to avoid or to shun, so that you can make sure that you have aligned yourself with the best financial path or the best investing strategy that you can have in your investment journey. So ladies and gentlemen, make sure that you don't do these mistakes. And if you are doing them right now, just find a way of trying to fix them so that you can have the best investment journey. So ladies and gentlemen, that's why you need to stay subscribed, or this is another reason that you should stay subscribed in this particular channel. And if you're seeing me for the first time, my name is Sir John Mweri. I'm a professional accountant with XFinop Accountancy and Insurance Consultancy. And this is what we do. We come here, we do a lot of videos to do with investments, businesses, finances, and so on, so that we can be able to help each other have a good financial path. And remember, our ultimate goal is financial freedom. So, ladies and gentlemen, make sure you watch that video up to the end so that you can grab each and every point that I've given you. So thank you so much. That was my time. Have a nice time. See you on the next.